A couple of formerly popular retailers, Dollar Tree and Dollar General, have both just collapsed over the past couple of weeks. And it's after they reported earnings that were much more disappointing than a lot of investors were expecting. Now, these were companies that had done fairly well as consumers were trading down to a little bit cheaper goods. And in a lot of places where they're operating, this is one of the only options for retail. If you drive around in small towns in America, you're probably going to see one of these two retailers, and it's going to be one of the go-to places for everyday goods. But what both of these companies are telling us is that their consumers are not doing particularly well. And so that's bearing out in the numbers. And what we're really seeing from a profitability standpoint is the operating leverage that you want to see from a company where revenue grows $1, but net income grows $2. So you're getting leverage on each dollar of growth. That works in the opposite direction when you're in an environment like today, where maybe revenue is declining a little bit. And as revenue is declining, your costs are actually going up. So your profitability isn't going down $1 with each dollar of revenue, it's going down $2. So this is the opposite of operating leverage. And I think that's exactly what we're seeing. The problem is there's no easy answer for these companies. And some of the comments from the recent conference calls, I think, were really alarming because they're seeing something with consumers that a lot of companies aren't. My name is Travis Hoium. Thanks for watching Asymmetric Investing. Please subscribe here on YouTube for all my content. And thanks to this video sponsor, The Motley Fool. If you go to fool.com/ASYM, they'll give you their top 10 stocks to buy right now. Let's start with the stock chart. This is a look at Dollar General, and you can see that it was right at the end of August when the company reported earnings that the stock dropped about 30%. Just a massive drop for a single day. I'll get to what they reported in some of their comments in just a second. It was actually today that Dollar Tree reported their quarter, and that's why we see shares down 35%. This is over the past week. If we just go to the past day, shares are down about 25% as I'm recording on Wednesday. So what in the world is happening? Let's go to Dollar Tree first. Now, the numbers aren't terrible when you look at their earnings. Same store sales for Dollar Tree up just slightly, 1.3%, Family Dollar down 0.1%, and for the enterprise as a whole, up 0.7%. So we do have a number of retailers where you're seeing same-store sales decline. That's not what you want to see for a retailer, but things are holding up okay for Dollar Tree. The big problem is these results were not as good as management had previously guided to. So when management gives guidance, if you don't live up to that guidance, investors say, hey, what in the world is going on? We're pricing the stock based on you hitting this guidance. And if you fall short of it, not only do we need to value your stock lower, but also we're wondering, do you know how to manage your business? So this gets to the outlook here for 2024. We're updating our full year outlook to reflect second quarter results, including general liability charge, a more conservative sales outlook at Dollar Tree, and incremental startup costs associated with the conversion of a recently acquired portfolio of 99-cent only stores. So sales are expected to be $30.6 to $30.9 billion with earnings of $5.20 to $5.60. So if we look at the company's recent results here, revenue is expected to be down a little bit. And earnings, if you go back to 2023, those were $7.20 per share, $5.30 for the October 2023 year. And obviously the numbers here that are negative include some write-downs. But it seems like the trend is generally lower for Dollar Tree's earnings. What do you see at Dollar General? You see a similar trend. Revenue growth is flattening out and earnings are falling. So those margins are falling across the board for the business. This is a look at their recent quarterly report. You can see that sales were up 4.2% to $10.2 billion, but same-store sales increased just 0.5%. Same-store sales for the full year expected to grow about 1 to 1.6%. And that is lower than the previous expectations of 2 to 2.7%. So again, the results aren't terrible. It isn't like competition is eating these businesses, but the results are a little bit worse than expected. And that's what the market is reacting to. Thanks to our friends at The Motley Fool for sponsoring this video. Visit fool.com/ASYM for the top 10 stocks to buy right now. Now, it wasn't actually results that were so surprising to me. It was the comments that management was making about the health of consumers. And this is from the Dollar Tree earnings conference call earlier this morning. This is COO Michael Creedon, who said the company is navigating through one of the most challenging macro environments we have ever seen. Now, Dollar Tree was founded in the 1950s. I can think of at least two macro environments in just the last 15 years that are worse than what we're experiencing so far in 2024. So to say that the consumer is so weak and the macro environment is so weak for the company in a year when we're experiencing GDP growth. Yes, there's a little bit of weakness on the lower end of the market. We're having a little bit of inflation. There are adjustments that businesses are going to have to go to. But when you go to blaming the macro environment like that, I think that is just telling. And what if we actually hit a real recession, either later this year or into 2025? How bad are things going to get at Dollar Tree and at Dollar General? And I think that's really what investors should be worried about, because if they're having this many problems with profitability while their revenue continues to grow, if they have negative same-store sales comps for an extended period of time, that is just going to be devastating for their business. I also wanted to highlight a couple of charts here. These show not only net income and revenue, that's what the columns are, but the orange line that you see is the return on assets. So I like to look first at return on assets. That doesn't account for what sort of debt you have on the balance sheet, which impacts things like return on equity. This is just, you have a whole bunch of assets. What are you getting as a return on those assets? Is that return justify you existing as a business? And right now, those return on assets have fallen from 12.7% in 2018 to down to 4.6%. If we go over to Dollar Tree, the numbers are even worse. Return on assets have been in the single digits for most of the past decade and have been negative recently. So this shows just how weak both of these businesses have been, and I think that's really telling for what investors are thinking about both of the stocks right now. That was what really set alarm bells off in my head. These are two stocks that I'm not an investor in, and in part because I think the headwinds facing both of these companies are just too big for them to overcome. Yes, they have, in a lot of cases, monopolies in a lot of the places where they have retail locations, but they're also in locations where population is in decline, where their consumers are not making more money year after year after year. So that is just not a foundation with which I want to be investing. And we're seeing some of these tailwinds right now. And if management thinks that the economy is terrible, and if they're making dire predictions about the macro environment right now, imagine how bad it's going to be if we do actually face a recession. So these are a couple of stocks I'm absolutely avoiding. Yes, they're starting to look like values, but keep in mind that those earnings are in decline. Revenue could potentially decline over the next year, and that is not where you want to be in a retailer because you don't know where the bottom is. But let me know your thoughts on Dollar Tree and Dollar General. Leave your comments in the comment section below. Don't forget to subscribe to Asymmetric Investing. Thanks for watching, everybody. See you here next time.